Welcome back to Be Great Economics. This is Nate. All right, so quick review. Last week we had a 40-minute video explaining the distribution phase here that went on in the NASDAQ, and we talked about how we went to a accumulation zone and we're expecting a rebound. Sure enough, last week we went through accumulation and through rebound, and what I saw on the shorter time frame was a Wyckoff accumulation. I called this on Twitter, pointed it out that, hey, we're probably going to go to liftoff from here because we were accumulating, and boom, we made it back in. So normally I don't like to stick to short-term time frames, but that was just to indicate the possibility of a reversal. Now I said that the probability was we were going to go through some type of dead cat bounce, or we break through and we continue on the trend with a long-term outlook of holding support way back here, where this trend line flows along in this sort of manner. I'm sorry, it was, we got to zoom out. Oh, we have such a long term with this trend. From here, from the COVID low, a long-term ascending trend line from here. Now I saw someone point out this may be a 5-part move where this is the second move up. You had 1, 2 for the corrective wave, 3, 4, and one final move from here. So why do I still think that there's an upside to here? Ultimately, it's going to have to do with the NASDAQ divided by the SPX and NDQ divided by the SPX. So I've been posting about this for a while. I bring it up almost every single week, that we are on a trend to continue to continue moving in a parabolic manner like we did in the early 2000s, late 90s. The NASDAQ is our representation of speculative growth assets, right? Now, the NASDAQ and the S&P 500 have become much more integrated in the past 20 years, 22 years since the 2000 dot-com bubble. Now, what I want to point out is the similarities in these trends are showing an accumulation above the prior all-time high. This is all technical. This is a response to speculative growth. Post-2000, we had loose money in the late 80s, early 90s. It pushed us up. We hit a limit once we went through a bunch of rate hikes into the later 90s, and then we finally hit a limit in the speculation, and the bubble popped and collapsed. Everything post 2020 was talking about how there's such high speculation on tech stocks and growth, but what did we really see? We saw barely a budge here. This run-up began before March 2020. This had nothing to do with what we know is now related to the virus. So most likely, this is just continuing the same trend. Yes, we've gotten some pretty volatile moves, but we should expect volatility as we get to the more insane side of things. Now, I've expressed that possibly we just go through distributive top simply because the speculation got put into other tech assets like crypto that doesn't show up here in the NASDAQ. But what I'm ultimately looking at is an expectation that the NASDAQ will still go for one final outperformance. And if we look here, we are on the weekly, so it's a long time frame. We see 1, 2, 3, we go through these 5. 1, 2, 3, 4, 5. One big move, right? We are seeing the same thing. 1, 2, 3, 4. What happens from here? Massive outperformance from the NASDAQ potentially, right? We've maintained an ascending line all the way from back in March, April 2020. So I would anticipate the NASDAQ to continue to outperform the S&P 500. Now the S&P 500 is still on its rampage, even though we have this low here. Now the same problem occurs for the NASDAQ or for the S&P as for the NASDAQ. What we're seeing in general is the same type of accumulation, a move up. Are we going to get rejected, right? Our trend line to watch at this point in time is simply this. Why? Because valuations are irrelevant. It's all TA. Valuations are irrelevant in this conversation because if you cared about valuations, you wouldn't be in the S&P 500. You wouldn't be in the NASDAQ. Quite frankly, period, point blank. If you have any interest in valuation, even if you're willing to speculate high, they are extremely overvalued even down here. Okay? The correction from the blow off top will fall below this line. Might not fall too far below. Don't know. Kind of depends on how bad the crash can be. We also have our massive Federal Reserve interest here on what is that going to do to us? Are we going to continue to the downside? Does the party keep going? Historically, like I've shown before, when rate hikes begin, prices at first shake and fall before the rate hikes actually begin when they're announced. Once they start, the rate hikes cause everyone to push out for further on the risk curve into a blow-off top until the rate hikes are too much, we can't handle the leverage, and we collapse. So I would say history says we're going to go for one final run, but there's always the possibility that we can't even stand the conversation of rate hikes, and we just continue on down. Either way, we get a fast enough result, you're going to start seeing a response from the Federal Reserve, because the liquidity crisis that could ensue from here is what the Fed will respond to. It's not the price of the stocks per se, although it matters. It matters to them. It is the liquidity crisis. And when we talk about a liquidity crisis, we're talking about seeking dollars. Now, we were starting to see that the dollar was in higher demand. However, it got rejected. Not only was the dollar in higher demand, which I would expect that this is going to get rejected further, that we've gone through some type of distributive top with a little bit of an up thrust here. I've seen a few people say this is a Wyckoff distribution. I don't know how to discern this one. It's a little more drastic, but I will say it seems like we've probably maximized this move here and we'll at least head a little lower for a while. But how bad was that total seeking for yield, right? That seeking for liquidity, sorry. Ultimately, we pushed back above the 1.75 line, the thing that we haven't really been able to breach into, and we went into a major area of confluence at the 1.75 to 1.8, 1.9. I think we kind of exaggerated this move as well. It's not to say that we can't move up, but when you look at the Fed purchases and they haven't reduced their balance sheet at all, what is it? I'll pull it up. What the Federal Reserve balance sheet has shown is that they are not reducing purchases at all, even though they keep talking about it. So unless March, we're just going to have it fall off a cliff, which I don't think they'll do either. The purchases are going to continue, which means they're going to continue to support banks purchasing bonds, because banks have to purchase bonds, and the government needs a low interest rate in order to be able to maintain supporting its own debt at 130% of our GDP. We're just not going to be able to taper this. This thing has gotten too big. Now, they're going to try, right? They're going to at least make it look like they attempt. And this motion here alone caused that whole 2018 taper tantrum. It got really bad, and then they reduced it, and then we hit 2020, right? So we'll probably see this response speed up because we are over leveraged and things will get worse very quickly. Overall, I think that we're looking at more shakeouts and more volatility in asset prices, but that volatility can be to the upside. This is like, to use David Hunter's term, picking up pennies in front of a steamroller. So I would risk very little to make reasonably large gains, because while a blow-off top can be life-changing, it can also be life-ending. You can experience some pretty bad things from there. So for our big trades that I do, the $1,000 to $1 million, this is our second trade, but our third attempt on it at it. I'm looking at copper. I'm expecting it to rebound. I bought here and I bought here. I'm almost completely deployed. About $1,850 will be into this trade, and we'll try to take it from here. Now, from a trader perspective, you would want to wait until you break out, retest, and resume from this trend line. I'm starting down here because I have a lot of confidence in it that this is a consolidation zone. I'm fine with holding out because it's a 6-month long term. It's not a short-term trade. So in terms of copper prices, I expect a run up. Now, why do I still expect run ups in prices? Ultimately, the supply chain issues have not been resolved. We're still dealing with shortages from miners. We're seeing higher energy costs, which means you're going to see higher sales costs or production costs into mining. Same thing for U.S. oil. While I expect there to be a correction here within the year, I expect to still go higher. I think that, again, I'm not rooting for this at all. I am a V8 driver. I love the environment, but don't care about the CO2 discussion. The the price of oil and the price of gas is probably going to go up, and that's just history talking on these traditional moves that oil can make. Let's go to the weekly. We can see it. These are massive moves, massive multiples, 15x's, 13x's, both the 1970s and the 2000s to the 2008. So in the next, by 2025, we could possibly be up well above $150. And I don't say that like, just some erratic speculator. I say that we have not placed enough investment into exploring for new oil. So overall, I think we're going to continue to see higher prices into commodities. I think that investing into the commodity space is probably a good move since it is extremely disliked right now. I think that the narrative got really bad down here where when oil crashed due to the pandemic, people were saying it wasn't going to come back. And it's like, are you nuts? Like, these transitions take time, and I think people lose track of reality when they are interested in their investments. So anyways, I think oil probably will continue up with a little bit of a corrective phase down again before we start moving up, because you can see we go through waves all the time, and we've probably overextended this wave here. Moving on to, we'll talk about uranium real quick. What are URA? Uranium, I said about 3 weeks ago, hey, it was right around here. Hey, uranium is getting overbought. It doesn't really match up with the fundamentals right at the moment. Yes, people are mining uranium at a loss. They are selling uranium at a loss. Factual. Hey, uranium can be a good long-term investment. Absolutely. Uranium is a green energy source. Maybe not renewable per se, but it is a better energy source alternate than most of the carbon emission stuff, if that's what they're concerned about. We saw the breakdown right after I said that, like that was like the top. So I timed that really well and said, no, this is not happening just because of a bunch of riots going on in Eastern Europe. So don't worry about it. And sure enough, we've gone down. Now we're back down into extreme lows here. I am not saying that uranium stocks are cheap at this price. The ones I like are Sky Harbor Resources, an exploring company, right? This is complete speculation. There's nothing produced by this company right now. All it does is own claims to places where there's uranium in the United States. Cool. You can bet on that, take a very large speculative bet with very small amounts allocated of capital for multiples in gains or massive losses. So that's one I like. Uranium Energy Corp is a royalty company that I find to be worth holding, but it is still extremely highly valued. I would expect a corrective wave to continue from here. We'll go over money commodities. We'll go over gold here real quick. When talking about gold, I am concerned about the overall possibility that we go through some type of distributive phase. Now, I know history is going to tell me that gold is going to start rallying, but that doesn't mean that we don't go through some type of crash. Now, most of the reason I think that gold would break down from here, below this up ascending trend line, the only reason that I can really say it would break down from here is because of a market crash. Deflation will crash all markets, and it doesn't matter because they have to deleverage. So be prepared for that. Pay attention to gold. But if the market doesn't crash, it begins its rally, gold will move up. Once the market begins to crash after that blow off top, gold will move down again with it a little bit. But if it's done at a slow pace, say like 2008 style, where it starts off in a saunter and you don't go through a massive deflationary event, that gives less incentive for the Federal Reserve to respond, which means that there's less deflationary response, which means there's less inflationary response. People panic and they start seeking yield, and the yield will be in precious metals. We know how these capital flows work because we have history to go from it. I know a lot of people think that for some reason, because the mathematical equation to assigning value to trading options, they use probability as n, and n is 0.5 for 50% chance of probability. It doesn't mean that the probability is 50% chance. It means that you don't know, so you treat it as a coin flip. You don't have enough data points. But we do have enough data points to know that capital flows at this stage begin to move into precious metals. Period. Point blank. History tells us this is what happens. Now, again, the volatility, the deflationary risks, the over-exuberance into other spaces can still send us lower from here. So when it comes to our Wyckoff accumulation in silver, I'm expecting that phase C, we've established it's begun. We're going to move into our final steps to see volume pick up. So we're going to watch for an ascending volume from here. We already saw ascending volume into the buying, but it continued to ascend into the selling. Now we're not really seeing trends of people giving in, so I think this is larger parties, possibly banks, reducing risk positions through shorting it out and trying to sell out through it. So this is like the last chance to get out of a bad short position, is if you get this dip in here, if they can get this dip to occur. But this dip probably only occurs if the market continues to crash. If the market doesn't completely crash and starts going to blow off mania, this can just go into like a low supply phase here where people are accumulating but not enough money is flowing into it. So overall, I think that precious metals are going to look good. Actually, let me bring up one I was looking at recently. I posted it on Twitter earlier today. Platinum is looking really good. Why do I say that? I was watching platinum before 2021 and saw that it was coming up to all-time highs from prior to or earlier in 2020 and said, hey, we're going to break out of that. We did break out of it, and the thing that I want to watch is this long-term downtrend. We have set above it and we've retested it twice, kind of a W bottom. What I would expect from here is to at least achieve this high again at a minimum. These are small earnings, right? Small growth opportunity, but let's go zoom out a little. This is some long-term opportunity. This got a little manic into the 2008 period, right? But platinum is part of lessening carbon emissions for ICE engines, which will not go away in the next 5 years. And platinum mining is going up in costs, and access to platinum is draining, and you need it for battery purposes as well. So I think that we're going to see platinum start to perform again with the rest of the commodities. So this is another opportunity. Just as a long-term investment goal, you can identify that overall platinum will probably start to appreciate. Finally, let's get to Bitcoin. So one thing I've been kicking myself a little bit for not recognizing that even though this matched the bond yields, this also is when we linked into tech stocks. And when we looked at you can go back and look at the NASDAQ to the S&P performance and realize, oh, these three heads here, right? This is the NASDAQ to S&P performance. This was following the trend NASDAQ versus S&P. This became a speculative move. We saw that larger institutional money started to play with futures derivatives, even though all the fundamentals, all the supply and demand dynamics other than the total trading volume are showing that Bitcoin is becoming progressively illiquid. We're at 14.6 million coins are in illiquid supply, meaning they're in wallets that usually don't move the coins after they get them. So what does that really mean to us? It means that around 15% of the remaining actual available supply of Bitcoin is up for trades anywhere. When we get down to 10% left on exchanges, it's usually pretty drastic in the effects, but since the trading volume is low because of the lack of speculation, we shouldn't expect a strong move up from here. Now, if the speculative boom kicks off, Bitcoin will probably follow that with the tech stock boom. I don't know if we make higher all-time highs or if we just come up above this 40,000 line. Right now we're in a little sandbox, as Benjamin Cowan says. We're in our sandbox 40K to 29K. I'm just, at this point, all I've done is accumulate some spot and let it sit. I said back here I was in leverage, got out of the leverage as soon as we started breaking down below this line because it was no longer feeding into my descending accumulation and low volume. I had a thesis on how that would work because it worked back here twice. It didn't work out here. I gave up. I said that we were at liquidation risk back here. We got it. I accumulated spot. I got out of leverage position that I entered back here because it just wasn't going to work out. And now we're just down here in the sandbox. And I'm accumulating spot, but I am not bothering with any type of leverage. I'm not seeing it as a trade. This is finally an area where I feel like we're back into a space that's near a bear market bottom. I posted another metric, probably worth looking at on Twitter and my Facebook that shows the total profit and loss Bitcoin spent ratio adjusted for entities. a guy on Twitter had built a way to show the absolute top and the absolute bottom of the market when it touches bands consistently when people are absolutely capitulating on selling. We're not really there yet, and so I think that leaves room to go as far as 24K. Now, just saying like, hey, we might go into the 20s, cool. Like anybody can be bearish at this point, right? Overall, I think that it's possible to go down there. I think we're going to fight it unless the markets start to crash. If we see deflation pick up, Bitcoin is going to respond pretty negatively to deflation. So just be prepared for all your cryptos to perform poorly in a very bad deflationary environment. Now, if we hit a real deflationary environment where there's liquidity seeking and we start hitting a liquidity crisis, then the Fed comes in. Then where's your best bet? It's going to be in Bitcoin. We have perfect supply dynamics. Now, that's not monetary assets like gold and silver are going to be much safer, much smarter move into a massive deflationary event. But Bitcoin is a speculative play on responding to Federal Reserve loose monetary policy. We have a history of every single one of these major moves being related to loose monetary policy. This is anomalous because it was derivative driven. A fair price for Bitcoin to me at this point would be under 45K. And since we're under 45K, I'm accumulating spot. Now I accumulated spot a little higher because, you know, quite frankly, I'm a dumb bull that just buys something that I like, right? Not every single thing that I do is absolutely buy the bottom. Some of it's just regular investor buying, and I'm just going to keep doing that. Same thing for gold. Gold could be at all-time highs, and I'm still going to purchase a little bit because I'm going to treat it like savings. I will not be very aggressive with Bitcoin if it's above 45K, but I'll buy some, right? Because I have a long-term 10-year thesis where this will be a flat line, and no one will think twice about why Bitcoin is so cheap by that point in time. But that's my own personal thesis on the long-term adoption of Bitcoin. Same thing with gold is I don't think gold's going anywhere. Not at least in the next decade, as much as people want to decry it. The decade after, maybe central banks start to sell it off. I doubt it. I think they're going to continue to hold it because they realize they can revalue it. They can use it as a form of money that can be trusted by anyone. So these are not necessarily looking to replace each other, but rather complement each other in terms of the ability to act as free market money. So thanks for watching. I hope that was a reasonable update for the week. I will be back with more videos, but I am in an online course right now that takes up all of my day. So I will see you next time, and hopefully I'll have some shorts posted. Bye.